So fed up. Forex, it's not for everyone.
Let's be honest, Forex trading is tough, and that is why 90% of Forex traders are losing money in the market according to my research. Only 10% are making money consistently in the Forex market. Even you who is watching this video, I believe you are still not profitable in Forex trading, and that is why you are here, trying to find out the truth and the secrets behind Forex trading for you to be able to take the right decision. I know you have watched so many videos on social media trying to look for a solution to your problem, but the situation gets worse. Do you know why? I will tell you. By the time you finish watching this video, your eyes will open and you will realize why you keep on losing money in Forex trading and why you should stop trading Forex. So without wasting time, let's jump into it. If you ask many Forex mentors why 90% of Forex traders lose money in the market, they will only talk about lack of knowledge and experience, lack of patience, lack of discipline, poor risk management, poor trading plan, emotional trading, over leveraging, over trading, and so on. But they will not tell you the main truth that I'm about to reveal to you now. Imagine you know how to analyze the market with technical analysis, you understand the market structure, you understand candlestick patterns, you understand chart patterns, and so many things that you should know, but you still lose money. So what is it that they are not telling you, and why are they keeping it a secret? So let me give you an answer in a simple way that you will understand so easily. There are two major secrets that 90% of Forex traders don't know about, and the second one is the most important one. So let me start with the first one. So let's say you are trading on USD JPY pair and you see a good uptrend structure forming higher lows and higher highs. So after forming the higher high, you are expecting the price to come back and form a new higher low before it continues with the upward movement. So this zone is going to be your entry point for a buy trade. So you wait patiently until the price reaches at the zone. Then you place a trade immediately it touches the zone, or even wait for a confirmation according to your entry strategy. So let's say you decide to wait for a confirmation candle, then boom, here it forms. So what next? You place a trade on the next candle and expect the price to continue going upwards to form a new higher high. So you place your stop loss below this zone and place your take profit at this zone. The price starts moving into your direction smoothly and you start getting excited, hoping it hit your take profit. So when it's about to hit your take profit after waiting for several minutes or even hours according to the time frame, then this happens. Boom. The market decides to take you out with just one candlestick. Imagine holding a trade for that long, feeling so excited because you are in deep profit, then an unexpected move takes all your profits away and hits your stop loss and lose your money within seconds. So how will you feel after this? Disappointed, right? Same to me here. I will feel very bad when this happens to me. But who is to be blamed for this? You or the market? The answer is you. Why? When trading Forex pairs, technical analysis is not just enough, no matter how good your strategy is. Forex pairs are more volatile because they are influenced by unpredictable real-world events. You need to understand so many factors affecting the Forex pairs, like knowing the cause of the price movement, when the volatility is high, when the volatility is low, and when there is news. These are often what separates the 10% who consistently make money from the 90% who lose money in the market. The Forex market moves based on supply and demand for currencies which are influenced by a combination of economic data, geopolitical events, central bank policies, market sentiment and speculation, news and unexpected events, trading hours or sessions, and lastly, technical analysis. All this creates crazy volatility that most beginners simply cannot handle. You might have the perfect strategy and boom, one news report wipes your account clean because the market is unpredictable during this time. So if you're a forex trader, especially if you're a beginner and you don't look at all these things, then you will continue losing money in the forex market over and over. This can be very stressful to many traders, and that's why most of them ignore these important things, which is a very big mistake. You need to be updated all the time about what's happening in the world, like elections, wars, natural disasters, or political instability that cause sudden volatility in the forex market. You need to keep your eyes on economic calendars and news all the time, just for you to know the right time to trade. But do you know that you can actually trade some financial instruments without looking at all these things and still make money? Now this is the secret that only 10% knows about, and you should also know about it. But before I reveal this secret to you, in case you are new here and you have not subscribed to this channel, then please consider subscribing now and turn on the notification bell so that anytime I upload videos like this, you will be the first person to be notified. As a forex trader, especially if you are a beginner and you want to succeed, stop trading instruments that can be affected by fundamentals. Trade assets that can be traded with pure price action without external disruptions. This is where synthetic indices comes in. This is where the majority of the smart 10% are getting their money, but they won't tell you. Synthetic indices are instruments that are generated by a cryptographically secure random number generator. They mimic real markets but are not affected by real-world news or market volatility. They simulate market conditions and maintain consistent volatility, allowing you to trade 24/7. If you look at these two charts, you will notice a difference due to candlesticks behavior. Synthetic indices have clear market structure than forex market, which makes it easier to predict. Unlike the forex market where you have to wait for specific trading sessions with high liquidity and volatility like London and New York session, synthetic indices are designed to have constant volatility depending on the specific index you are trading. Each index is programmed to simulate market behavior with a fixed or controlled volatility level. For example, Volatility 25 Index simulates a market with 25% constant volatility, and 75 Index simulates a market with 75% constant volatility. This means you will not see unpredictable volatility spikes like in real markets, especially during news events. The other good thing about synthetic indices is that they have lower and more stable spreads compared to forex pairs, which is an advantage to scalpers and day traders. So where do you get synthetic indices and how do you trade them? First of all, for you to trade synthetic indices, you need to have a Deriv MT5 account. Deriv has been around for 25 years and it is the only trusted broker that provides synthetic indices. Currently, it has over 3 million traders, and for you to be one of them, just create a free account with the link in the description and start trading synthetic indices today. So if you have created your account, now let me show you how to trade synthetic indices. For you to trade synthetic indices, you don't need complicated strategies with big names like SMC, ICT, and wherever. You just need to keep it simple with price action analysis. The strategies that works perfectly on synthetic indices are trendline reversal strategy and a trendline breakout strategy. So let me start with a trendline reversal strategy. A trendline reversal strategy is one of the most basic and effective price action strategy in trading. It involves drawing lines on your chart to help identify the reversal points on the market and then using those lines to find trading opportunities. First, you identify a clear trend with at least 2 highs and 2 lows. Then you draw the trend line to connect the highs and lows. Then you extend the trend line to the future to act as a level of support or resistance according to the trend. In an uptrend, you draw the trend line below price connecting higher lows, and in a downtrend, you draw the trend line above price connecting lower highs. After that, you wait for the price to touch the trend line for the 3rd time or the 4th time. Then you wait for a reversal confirmation signal. Then you place a down trade, expecting the price to continue going downwards, targeting the previous lower low as TP. Same to uptrend, you wait for the price to touch the trend line for the third time or the fourth time, then you wait for the reversal confirmation signal, then you place an up trade expecting the price to continue going upwards, targeting the previous higher high as TP. The second strategy is the trendline breakout strategy. First, you identify a clear trend with at least 2 highs or 2 lows, then you draw the trend line to connect the highs and lows. Then you extend the trend line to the future to act as a level of support or resistance according to the trend. After that, you wait for the price to break the trend line, then you wait for the price to retest the trend line. After retesting the trend line, you wait for a reversal confirmation signal, then you place a down trade expecting the price to continue going downwards. Same to downtrend, you wait for the price to break the trend line, then you wait for the price to retest the trend line. After retesting the trend line, then you wait for the reversal confirmation signal, then you place an up trade expecting the price to continue going upwards. That's how simple it is to trade synthetic indices. All you need is to understand price action. So if you are not profitable in the forex market, then I think this is the right time for you to try synthetic indices. If you want to start trading synthetic indices, then just create a free Deriv MT5 account with the link in the description of this video and start making money. If you have learned something in this video, then please like and share, and if you want to learn more about synthetic indices strategies, you can join my Telegram channel with the link in the description. In case you are new here and you have not subscribed to this channel, then please consider subscribing now and turn on the notification bell so that anytime I upload videos like this, you will be the first person to be notified. Thanks a lot for watching this video to the end. Let's meet in the next video.